Joining me now is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Great to see you, sir.
Great to see you. Thanks for having me on.
Yeah, for sure. Now, we know that commodities generally have been weakening. So let's start with your overall view of the commodity complex right now.
It's a bear market. I think it's indicative of a lack of demand pull, a lack of economic progress in the world, and a world tilting towards a pretty severe recession. I'm calling it the Great Economic Reset, maybe the greatest economic reset of our lifetime. So let's look at the Bloomberg Commodity Index. It's the largest index. It's down about 20% on a 12-month basis. It peaked in June of last year, and it's part of what's leading things like the Producer Price Index. The Producer Price Index, about 3%, is falling at the fastest pace in history since 1948. So what I see, Mark, is a market that is clearly showing deflationary trends. And the Fed is still tightening. They might be done tightening now, but they went from 0 to 5% at the fastest pace in history. And we're just starting that process of long and variable lag. So from a commodity standpoint, they're leading that indication that we're heading towards a severe deflationary recession. And it's the question of what's the next shoe to drop. So I watch things like cryptos are starting to tick down, and the final major shoe after copper and crude oil and natural gas and bond yields and credit spread and banks. The final is a broad stock market. If that goes down, there's no hope for this. That's severe deflation.
And when you say maybe the biggest reset we've ever seen, is that because of low rates for so long, for 30 plus years, if not longer, and now this inflationary situation that the Fed has been tightening into?
So it's partly created by them. They're not completely culpable. We had a 100-year event with the plague, the pandemic, right, and we had the biggest pump in liquidity ever. And now we're dumping. So all the lessons of history, all the lessons of booms and then busts are in the back of liquidity. And we're having the biggest pump, then dump ever. So to me, it's irrational not to expect reciprocity in that process. Now it's happening right now. What I mentioned, the Producer Price Index. I'm a commodity guy. I like to focus on that. It's basically a 2 beta to the CPI. And it's like I said, the Producer Price Index is dropping the fastest pace in history. Now everything else is lagging things like the commodity market. So I look at it as this is a confluence of 100-year events. This is all the lessons of history that maybe will be different this time. But when you have pumps in liquidity, biggest ever, that dumps, which we still are, you just look at the bank deposits in the U.S., classic credit contraction. It's just the concept of tightening in that environment. History from the future will look back and say, yes, that was what created part of its potential next big depression. Now, I hope that doesn't happen, but I'm just pointing out facts of how things work in cycles in history. And that's the bottom line, is the Fed has been tightening into this deflationary environment, and there's one key final shoe. That's the U.S. equity market. So I'm looking at Bloomberg Intelligence. I have the benefit of being no bias. So my colleague, Anna Wong, our head of economists, he says that the contraction of U.S. economic activity is probably going to start in July. That's right about the same time we're going to get the July PPI number, the June PPI number, which is going to show negative on a year-over-year basis. Also, now we have this budget impasse with the government potentially running out of money by the end of June. It's just the key thing is the recession, if you look at things like the yield curve and money supply, is just inevitable. And the key point I like is the consensus it's going to be a soft landing. So I look at it and put in my trading hat. I used to be in the trading pits in Chicago. I put in my trading hat. So where's the optionality? Where's the vig in that is to bet against it? Because we're already priced in for a bit of a soft landing. I think it's going to be a normal, pretty severe recession. And that's just based on typical cycles of liquidity.
Right. And you make a good point about how pretty well everything peaked in Q4 of 21. We've been going down the other side of the mountain since then. The cycle is cycling. It hasn't completed yet. And so, yeah, the writing seems to be on the wall, especially in terms of the rate of change. Let's talk about gold. Do you think it could be on the verge of a significant breakout, sitting around near all-time highs right now? Yeah, there's so many things that affect it. But is the one main thing real interest rates? Do you think the way it moves?
Yeah, so let's look at right now, gold is on the cusp, I think, of a breakout, a rally, akin to right before the financial crisis, right? In 2007, 8 is knocking around 800. Remember, that was resistance in the 1,000 and popped to 1,900. boom, I think it's just going to go from eventually around a 2 bid. I'm being in the trade, it's going to go three bid. It's going up to $3,000 an ounce. It's a question of what stops it. Now, it's made new highs in the euro and in the yen, and the fundamentals are so solid. The bottom line for gold is what's repressed gold for the last 10 years is probably going to change. And that was with the outperformance of the U.S. stock market. Real yields is part of it. Once we get to that inflection point of the Fed having to ease because deflation forces are so overwhelming, which I point out in commodities, gold should take off. Now, it's starting to do that. I just question how it does it. But the key thing I want to leave you with is for the last almost more than 10 years, the U.S. stock market has outperformed the world exponentially. If you look at U.S. S&P 500 versus the MSCI ex-U.S. And my colleague Gina Martin Adams taught me about this. She's our equity strategist. It's outperformed. It's way above GDP, the most ever. Now it's turning backwards. It's the most ever above housing. It's just starting to revert. Now in that environment, when you're a boomer, there's no reason to touch gold when the U.S. stock market was blasting off. And now it's starting to come back, and it's got so much just simple mean reversion room. I think that's going to be the catalyst when the boomers who can make 5% on 2-year notes in March, remember that was right before the bank crisis kicked in, and now can make 4% in 2-year notes, and here we are in May, going to go to 3% and 2% in a matter of time. It leaves gold as to me one of the best performing major potential assets. And that's the current trajectory. Gold, up about 10% on a 12-month basis, is beating almost every major asset there is, even Bitcoin. And I fully expect it to continue.
It said that risk happens slowly, then all at once. You said that gold will rise gradually and then suddenly. Yeah. And then Rob McGlone, who's here at this event for years now, he said gold at 5,000. And that seems a bit pie in the sky, but you're saying 3,000. What's the time frame there, do you figure?
There you go. So as a strategist, putting time and price together is a lesson I've learned the hard way. Now, I used to structure option positions. I used to trade option positions. For me, every time I put on a good option position, I was right, except the market, options position expired before the market had a chance to get to my strike. So I have to be careful. I don't know the time frame, but I think right now there's a lot that's going to depend on my base case for a severe economic deflationary reset based on just all the cycles in history, makes gold an outstanding feature along with U.S. Treasury long bonds. So I don't know how high it's going to go. I do even think I've been bullish Bitcoin. I'm still bullish Bitcoin, but I think gold's going to continue outperforming Bitcoin. Remember, I look at things like the Bitcoin gold ratio. It's right around 14 per ounce Bitcoin to gold. Now, the way I look at it, in this world of rapidly advancing digitalization technology, you can't really hold gold as an investment anymore without that digital port in there, maybe a couple percent. But I still think with the world, that's the risk asset, and this is a risk-off asset. So how high it goes, I don't know, but it's trickling up above 2,000 on a month-end basis. On the quarter-end basis, when we entered Q1, it was the highest ever. If you look at it on a month-end basis right now, it's the highest ever in U.S. dollars. So if we get weakness in the dollar, it's nothing but upside for gold. And I'll leave it with this. When people say they're bullish on silver, I'm like, yeah, there's one problem with silver. It's probably more likely to trade like copper, which is going to go down in a global recession, a U.S. recession. And central banks are buying gold, not silver.
Right. And it does have that industrial application more than gold. And yeah, you make a good point there. So you've been talking about all the tailwinds here for gold. And I don't want to date you, but I'm sure you remember what happened around 1980 during that mania. Is this perhaps the best setup you've ever seen for gold in your career? It is. And particularly because you have to get maximum disdain. Now, we've seen this. It's in markets. You just have to get maximum disdain for markets to go the right way. Because when everybody's on board, it's not going to work. We've got pretty close to maximum disdain. I mean, it's been knocking around between $1,600 and $2,000 forever. It's got that triple top at 2,000 since basically about 20. Keeps doing it, and there's a little lesson we learned in trading pits: triple tops are made to be broken. And it's at the point where I think what's going to happen is we have a point where you have the crypto people. There's a lot of money made there, and they call it boomer rocks, just pushing back, and you have to have disdain. We're calling gold boomer rocks. I'm like, okay, well, boomers have money. And they've made a lot of money in the stock market last few years. And when 2 years went to 5%, they said, thank you, I'm locking in there. I'm not touching the U.S. stock market. I'm good. If you're 72 years old. So I look at it as there's going to be here's my prediction. And this is one of the greater risks of what I do is predicting the future. No problem, right? So my prediction is there's going to be FOMO into gold. Because price goes up will bring in more interest because it's had so much disdain, it's just going to continue to rise. Partly, and the fundamentals are overwhelming. And a lot of that money is going to come from traditional assets. Housing's peaked, potentially.
Stock market's probably peaked, and I think it's going to drop. Just a normal correction, this S&P 500 will drop from peak to trough 50%. It did that in the last 2 recessions. So taking money out there means people are scrambling for anything they can. And if I'm right about this deflationary trends, which has already happened in commodities, yields are going to go down. There's only really one major asset left. It's gold.
Mike, as we speak, President Biden and House Speaker McCarthy are going to be meeting today. We've got the debt ceiling looming. We remember what happened in 2011.
Yeah.
Gold hit an all-time high. S&P downgraded U.S. debt.
Yeah.
The S&P 500 fell 20% over 4 months. Are we, because both sides seem so intractable in their positions, are we leading to something breaking, or will they go down to the wire and have a solution?
The number one factor, I think, to break that impasse and get them together is the stock market going down. Once they read in the Washington Post and New York Times that U.S. stock market is declining 10% because the U.S. government is having this impasse, they'll come to agreement. Remember 2011? It worked. I was at S&P when they downgraded the U.S. government. So I'm worried about it, but this is one of the things people have to remember is the part of the greatness of America. And we openly debate and discourse everything. Now, Churchill says we will come to the ultimate proper conclusion after exhausting all other alternatives. This is part of that. It's messy. Everybody, I hate hearing default in U.S. government in one sentence. That's an oxymoron. But we'll come to terms. And the key bottom line for me is it might take a decline in the stock market to make them come to agreement, which is part of my lose-lose for equities and the Fed tightening. But gold is also the unequivocal alternative. And Bitcoin's in there too, because there's assets that you can flip around and transact and transmit. I can show my phone instantly. And Bitcoin's part of that. That's an alternative to U.S. Treasuries, the world's safest assets. But I look at it as this is part of discourse. You're not going to see this in China. You're not going to see it in Russia. It's just the way the autocratic leader says. In this country, we knock it around, we debate. And what's the debate? It's these two great parties with different views, but we'll come together at some point. And I'm afraid it's going to be a tough one.
Great stuff, Mike. We'll look forward to seeing all that play out.
Thank you.
All right.
Thanks for having me.
Mike McGlone from Bloomberg Intelligence.